Good evening, ladies and gentlemen. This is Barry Norman on behalf of ETX, and welcome to our second class in Building Your Trading Foundations. And tonight we're going to be discussing trends and trend lines. Now, for those of you who have joined us for the first time, ETX is a regulated provider, and I'm therefore required to give you a risk warning. Trading in financial markets can result in the loss of the amount invested. Do not trade with funds that you cannot afford to lose, and seek advice if you do not understand the risks. All information provided in this webinar is for educational purposes only. ETS Capital and the presenter are not financial or investment advisors and do not recommend any securities or instruments of any kind. Any securities we mention tonight are for educational purposes only. Now tonight I will be showing you some live charts, but in no way, shape, or form are those charts indications that you should be making a trade. They are randomly chosen charts from today's market to show you trends and trend lines. So let's get on with the trend is your friend. Now tonight's class is being recorded. If you would like to see a recorded version of this class after it's over, in about 24 hours, use the same link you used to come to tonight's class, and you can see a recorded version. Now, learning how to read a Forex chart is considered to be somewhat of a science. They look complicated at first. Forex charts can look drastically different depending on what options you select. Charts usually have settings for display style and price and time. But the reason we learn to use Forex charts or commodities charts and stock charts is so that we can start building technical analysis and understanding how price is moving and see price in a graphical visual formation. Now, the first part of our building foundations, which we had last week, was learning the different types of charts. And as we discussed, there's a line chart, a bar chart, and a candlestick chart. Now, once we've set up our chart, we want to start to identify ways to determine if there's a trend and the direction of the trend. Now, please don't mix up trend and trend lines. They are two separate concepts. Trading with the trend is trading with the flow. When the prevailing trend is up, why would you want to look for short entries when buying might result in much smoother trades? Many amateur traders, even when facing a long-lasting trend that has been going on for months, just can't stop trying to predict reversals. Whereas they could have made so much more money by simply joining the trend. But even if you're not a trend following trader, you can combine this concept of trading with a higher time frame trend with your regular trading approach. You start on a daily time frame and see if the trend is up, down, or sideways. And then you would use information on a lower execution time frame to time your trades, to be able to correctly read price action, trends, and trend direction. So the simple way is with a chart. And let me pop up a live chart on our screen. Okay, and we're looking at the price, we're looking at the euro US dollar, and let's go, we're looking at a one-day chart. So this chart covers a period since November of last year. We would say the euro is moving in an uptrend, correctly? If we were to move this down to a 2-hour chart, okay, we would see it's also moving in an uptrend, although at a slight retracement, but it's moved back to its uptrend. If we look at it in a 1-hour chart, we can see it had a very hard uptrend. That's when it recovered in that time being, and it's moving into some congestion now. But if we move it into a shorter term chart, we see it is in a short term moving in a very defined uptrend. Now, why would we want to ever trade against this trend? When we look at it in 4 different time frames, everything tells us that euro is moving up. Now, lots of gamblers would like to say, the euro peaked now, and we think we're going to make some profit. Trading could go down. You can be a contra trader, but you will find in the long term, you will make more pips on trades to go with the trend and less losses than if you traded against the trend. So one of the simple ways is simply using a line graph to identify a trend. Most traders use bar or candles when it comes to observing charts, but completely forget about a very effective and simple tool to allow them to look through all the clutter and noise, and that's a line graph. The purpose of bar and candlestick charts is to provide detailed information about what is happening on the markets, but it is really necessary when it comes to identifying the overall trend? Probably not. So if we go back to this euro US dollar, we might want to take out all this noise by simply converting it over to a line chart, which is the simplest chart of it all. But that gives us a clear-cut way to see the trend. It's not my recommended way, but it is one of the possible ways. I don't personally use a line chart for anything. A trader would do well to zoom out from time to time, at least once a week, and switch to a line graph to get a better, clearer picture of what is currently happening. And since our only goal is to identify the direction, and that's all we're doing at this point, identifying the direction that an asset is moving. So, and since our only goal is to identify the direction, the line graph is a perfect starting point, especially when we're on a higher time frame and we just want to identify the overall market direction. But there's a much better way, a more accurate way to identify trends, and that is using highs and lows. This is one of my personal favorites because I like analyzing charts. And although it sounds simple, it's usually everything you need. Conventional technical analysis says that during an uptrend, you have higher highs because the buyers are in the majority and push prices higher. And lows are also higher because buyers keep buying the dips. It works the same during a downtrend, but in reverse. And if you can identify the swing highs and swing lows, the highest point that asset's trading, and this is using candlesticks because you want the highest point it is touched, then you can identify a trend. Again, it is not too important to get totally lost if you're using the trend direction just as a filter for your trades. In most cases, you should be able to tell relatively quickly whether you're in an uptrend or a downtrend or a range trade. Rule of thumb, if you can't tell what is happening on your charts quickly, it's usually better to stand aside until you can see clearly. There's lots of times, and it could be for a long period of time, where an asset is just chopping. It's not in an uptrend, it's not in a downtrend, it's hardly even in a sideways, it's just all over the place. Now, when you can't distinguish an uptrend, a downtrend, or a sideways trend, it's time to move away from that asset. Now, one of the most well-known ways to identify a trend is simple moving averages. Because what a moving average does, it takes the noise out of the markets. So it's almost like a line chart, but it's used more calculations and it's used with candlesticks or bar charts. Moving averages are undoubtedly among the most popular trading tools, and they are great to identify the market direction as well. However, there are a few things to be aware of when it comes to analyzing trend direction with moving averages. The trend length of a moving average highly impacts when you get a signal when markets turn. Well, Since we're only using to identify the direction of the market, and we're not using to make trade decisions, a moving average works perfect for identifying the trend of the markets. So a small, or what we call fast moving average, might give a lot of earlier false signals because it reacts too soon to minor price movements. On the other hand, a fast moving average can get you out early when the trend is about to change. A slow moving average might provide signals too late or can help you trade the trend longer. But again, when we're using this, moving averages work wonderful as trading signals, but not just a simple one-line moving average. You know, a 10 and a 20, or 20 and a 30, and a 9 and a 15. All can tell you this through crossovers. But a moving average simply takes the noise out of the markets and lets you see what the overall trend of the market is. So in the screenshot below, or on the right, we use the 50 EMA, which is a midterm moving average. You can see that during an uptrend, prices stayed well above the moving average. And once prices crossed the moving average, it entered a range. Now, using moving averages is only tricky as you have to determine the right length, the right size of the moving average, which changes drastically from market to market to market. You wouldn't use the same length moving average for stocks as you would for Forex. You wouldn't use the same one for commodities, and you'd use a completely different one for cryptocurrency. But it's simply the number of days in your calculation, number of time periods. Now we come to channels and trend lines, which is another way that, because remember, right now we're only simply trying to determine the direction of the trend or the direction of the market and determining if there is an actual direction. So channels and trend lines are another way to identify the direction of a trend, and they also help you understand range markets much better. Whereas moving averages and the analysis of highs and lows can also be used during early trend stages, trend lines are better suited for later stages because you need at least 2 touch points, better 3, to draw a trend line. So I mainly use trend lines to identify changes of the established trend. Now remember, a trend line is completely different than a trend, because once a trend line has been broken by price, that trend line is no longer valid. Whereas a trend can dip down and recover, dip down and recover, and it can still continue to be an uptrend. So trend lines during ranges are ideal when it comes to finding breakout scenarios and when price enters the trending mode again. Also, trend lines can be used to combine with moving averages nicely because they have complementary characteristics. So the best way to identify and start trading is the use of a trend line. Once you've identified the market, and see, you can have a short-term uptrend with a medium-term downtrend and a long-term uptrend. Okay, you have to be able to see the time periods you're looking at. Yeah, so if I were to say to you, gold is in an uptrend because gold from 1989 to now rose from 300. Excuse me, I'm just getting over the flu. Okay. If I told you gold rose from 389 to $1,200, that's a nice uptrend. But if you were looking at a shorter term period where gold was at $1,900 and fell down to $1,200, you're looking at a downtrend. So you have to understand the different types of trends you have, and that's why you want to look at different periods. Because if you're looking for long-term investment in gold, you're looking for short-term, but you have to understand the market. You have to have some understanding of the personality of the asset you're looking at. Now, trend lines give that market some definition because it adds a set of very defined rules. And what this helps you do is helps you start seeing and understanding what everybody else is looking at. Because if you draw a trend line by the rules, so is the guy across the world, so is the million other traders. So now you can tell what price is critically important as price is moving up or down. And when price touches that trend line or breaks that trend line, you want to see the market reaction because you knew that price was critically important. We don't know if it's going to bounce off that trend line or fall below it, but we know something's going to happen at that price. So when you know something's going to happen, you can be prepared for it. So trend lines are a useful tool for visually highlighting a trend and potentially being part of a trading strategy. There's a lot of mis and inaccurate information about trend lines though. Learning how to use trend lines effectively, if you're going to use them, is crucial so you don't fall into the common traps. Trend lines are a technical analysis tool used to define and project price trends in major markets such as stocks, Forex, futures, cryptos. Trend lines have the potential to alert us to pullbacks. When a trend is over, the trend is resuming, when a trend is accelerating, when a trend is reversing. Price is the ultimate indicator though, and therefore price action must always be considered when using trend lines. Now, trend lines are drawn on a chart to help predict the general direction of price. They also help you see reversals. Trend lines also help to determine good entry and exit points and help you decide where to put your stops. They are quite good. Like any form of analysis, if used alone, they won't make you many pips. However, they may make a great addition to your trading arsenal. So remember the adage, the trend is your friend. The main problem with trend lines is placing them on your chart. It can be a little intimidating to start, but you'll find once you get a hang of it, it's quite easy. So the purpose of drawing trend lines is to identify where possible reversals will take place. They can also signal a change in the trend may occur. In an uptrend, you draw the lines along the lowest point in the trend without letting a line cross through the prices. You need at least 2 touches of the trend line. So drawing a trend line sounds easy because I have students tell me I can always connect 2 lines together. It's not so easy because it's not simply connecting 2 lines. Hold on, let me just pop my charts up here and we're going to draw a trend line on here together. Can you hold on 1 second? I lost the page here. Sorry about that. So we're going to go back to the euro US dollar and we're going to go to, I like bar charts, so you can use candlestick charts as well. Now, to find the proper trend line, let's use a 1-hour chart. For this, you can use whatever time frame you want to use. Whatever time frame you're using for your trading strategy is where you would use the same chart for your decisions. So what we want to do is locate what we're going to call the significant swing low or the significant swing high. If it's an uptrend, we're looking for a significant swing low. And then we want to, we want to then draw a line. Now, the fact is that the line cannot be broken at any times. So if we would have previously drawn a trend line like this, once it got broken here, it's over. So to draw a current trend line, we have to make sure no points break that trend line. So let's drop a real one on the chart. Okay, so this would be the proper trend line for the Euro US dollar 1 hour chart. Because as you can see, price has not violated that trend line anywhere. We've used a significant swing low. We've attached it to another swing low because that's all you can do. But that seemed pretty easy, didn't it? But the fact is, we just drew a line. It has no value. Doesn't tell us anything. Because in order to have a trend line become an active trend line, it must have a third point in common. So until price touches that trend line at another time, we don't have an active trend line. So this is where it becomes difficult. So in this case, we need a way for price to continue moving forward to activate this trend line. Or we can look for a different one over a longer period of time. We can look at a different time frame. But still, if you notice here in a 3-hour time frame, we still don't have any validity here. And if we were to go back to this previous swing low, here, or here, or here, we still have no, because we can't come above that point and we can't get up to that point. So you see that? You can't draw a trend line except for here. So we don't have an active, valid trend line. Now, the fact is, we do have a valid trend as opposed to a valid trend line. So if we were to go back to our original one-day chart, right now, this is the only valid trend line that I can find because we have 1, 2, 3, 4 points in common, but price has never violated this line, and price is well above it. But that's not going to help us right now where price is trading. So let's go back to my PowerPoint and let's talk about this a little bit more. So there are two main types of trend lines: bullish trend lines and bearish trend lines. They're exactly the same, except they're the reverse. A bullish trend line has a positive slope and is formed by connecting 2 or more low points. The second swing low must be higher than the first swing low and must be drawn under price. In a bearish or downtrend, we would be drawing the trend line over top of the price. So a bearish trend line is formed by connecting 2 or more highs, and the second swing high must be lower than the first swing high. Exactly the reverse. So we have the same problem here that we just had on the Euro US dollar chart. Because the trend is your friend, but like all other friendships, it's a complicated one. Unless you understand the nature of a trend, your friendship is destined to fail. As many traders quickly realize, there is a great deal more to trading successfully than merely identifying a securities trend and buying pullback in an uptrend or shorting bounces in a downtrend. So let's begin with the basics. An uptrend is a series of higher highs and higher lows displayed on a price chart. A downtrend consists of lower lows and lower highs. And this is important because the trend or the price trend in which you're moving, besides being able to draw a line on there, needs to explain the trend. And a trend, a well-deformed trend, is a series of pushes and eases, pushes and eases, pushes and eases. If you understand this, you won't panic when price starts moving against you. You'll realize this is how a trend is supposed to work. And you say, hey, this is what I'm supposed to see. Because price doesn't move in a straight line this way. Okay, it moves and pushes and eases. It'll get there. But what is you don't want to panic every time price eases back, eases back down. So you need to understand the development and what a trend should be looking like. So a trend consists of higher highs and higher lows, higher highs and then higher lows, and then higher highs. A trading range consists of highs and lows that are equal to each other, where a downtrend is made up of lower lows and lower highs, lower lows and lower highs. And this is what the trend should be made up with. So there are two major obstacles you will run into in attempting to apply this traditional wisdom. First, not all trends are regular. In other words, while one type of trend support level may hold well in an uptrend, such as a popular 20-day moving average, in another trend, it might hold that a 10-day moving average on one pullback, then a 20-day period on the second, then something somewhere between as it advances higher. In each case, however, the security continues to make higher highs and higher lows, thus holding an uptrend. When different support levels hold within the trend, it can be difficult to know which one to use as a guide for initiating a long position. Okay. So you have to know what a trend is, how to define a trend, how to use the trend lines in that trend, and understand the proper formation of a trend. You also have to keep in mind that no trend lasts forever. At some point, an uptrend will become exhausted and will break through support instead of pulling back into it and bouncing, and then continuing higher once again. Without a solid understanding of how trends exhaust themselves and the tools for recognizing different types of exhaustion and how they affect the correction of a trend, you can easily find yourself on the wrong side of a market move. So most traders who pick up a book on technical analysis will run into the concept of trend formation or trend development, whereby the trend consists of a series of 3 waves of upside, then often punctuated by 2 smaller waves. Templates for trend development are typically similar to the one we see over here. Now, I personally don't believe in this. I believe in pushes, thrusts, push and thrusts, peaks and valleys. But I don't believe, but a lot of people do, that you have a larger push, then you have an ease, and then you're going to have a smaller push, and then an ease, and the second wave in here will be your largest push. Then you'll have an ease, a smaller bounce back, come down to the trend, and then a bigger push. A lot of people say that the push number 2 is where you make the most pips. I just cannot, in all of my trading, believe this. Okay, I'm not saying it's incorrect. I just don't see it, because assets can remain, like you look on the euro US dollar, That asset's remained in an uptrend for a very long time and has had many pushes and eases, pushes and eases. So I'm not sure how many markets this holds true in, and I wouldn't bet my bottom dollar on it. But trend lines are one of the most used and misused tools in a trader's toolbox. If you're going to use them, you have to have a consistent methodology that defines when you will draw them, where you will draw them, and what you will do when price touches them. Too many times I have seen traders draw random lines on charts with the argument that they might not use it, but it's good to have it there. I tend to disagree. If you don't have a specific rules, then you will draw lines you wish were there instead of ones that should be there. If you do not have consistent rules, then you are probably just drawing random lines on charts, which cannot help your trading and will probably hurt you. So first of all, we should define what we expect out of a trend line. There are legitimate trend lines connecting lows of a move to highs of another move, drawn on a best fit effort through the center of price action, or drawn through a number of other chart points. I have found most of these to be useful in my own trading experience. I expect something very consistent from a trend line. So you're going to see lots of people out there preaching stuff. Use my trend trading theory, and you draw this line at this point, and this point, and this point. That's their practice. Okay. One of the main reasons I believe in trend lines and use them all the time is because I want to know what price the markets are looking for. What price can I predict that trader in Brazil is going to sell that asset, or he's going to buy that asset? He's going to enter and exit the market. So I see price coming down to that trend line. I know he's looking at that same number I am. I don't know what he's going to do. But if I see what he does afterwards, I can then judge what I can expect. So the main reason I will use a trend line is to delineate the conditions that define the current trend of the markets. If the trend line correctly defines those conditions, then penetrations of the trend lines are significant. We will explore some future refinements of using trend lines in future posts and future webinars. But for now, let's just focus on the most consistent element, and that's consistency. There is one specific price point that a valid trend line should capture without cutting through other prices. The low immediately preceding the new high of the trend line. Now, this is a little bit difficult to find because it sounds easy. So I say, in my rule, and a lot of people's rules, is you have to find the significant low or the significant high in the other way. Because a lot of times price will do all kinds of weird things for a second or two, but has no validity. So finding what's called the swing low. And then ideally the trend line should also extend from the actual beginning of the trend, as it does in the example that I'm going to show you or that we looked at. But that is not essential. If the trend has accelerated, it will not be possible to draw a single long trend line. Note that the trend line may cut through prices past the high, but it should not pass through any price bars before the low. In other words, if a price violates the trend line, but is only the low of a candlestick or low of a bar chart, but the close stays above it, that is perfectly fine. But you can see on this chart, you're constantly redefining your trend line because as price moves, it violates that trend line. You have to locate the new trend line, the new one, the new one, and the new one, because you've got to hold to the rules. So first, the trend line defines the limits of the swing that compose the trend. So it's important to be sure that actually are swings before you draw your line. For instance, if you see many consecutive bars where you can draw a line across the lows, of those bars, a trend line drawn across those lows will probably not be meaningful. So once the trend line is placed, it has to have a third bounce to become active. Now that the price should find support and resistance at that trend line, it should have trouble breaking that line. And if the price does break that line, it usually means the trend is over. So placing lines is pretty easy. All you need to do is identify two swing lows or highs and draw a line joining them. There you have it. Now your chart has trend lines. But wait a minute, newbie. Even though you've placed a trend line based on two swing lows and two swing highs, the trend remains unconfirmed until it hits a third point. That means that it's not valid. It means it has no value to you at this point. So we need to validate and verify. So this chart is the same price chart we've been using throughout here. So here's where we saw how to build a bullish trend line. Here's, come on, where's my chart? Okay, here's where we started with the bullish trend line. So we were able to draw this trend line on the chart with only two connecting swing lows. So it's not valid yet. So as we continue forward, as the market continues to move, what we got here now in this same price action is that third swing low point. Now that tells us that that trend is valid. It could have even given us an entry to buy into that market. Now moving over here to the next stop, okay, we see the price moved up, it came back to that trend line and it violated that trend line. Now it happened to move into a downward trend, but the minute it violated that trend line was no longer valid. So number one, you have to make sure you're drawing them correctly, because a lot of times our eye would have liked to draw this one below because it looks like, oh, that's how that asset's moving. But you cannot have that violation. So your proper trend line would have been here where the check mark is. So remember, we want to connect swing lows to swing lows or swing highs to swing highs. The more connecting points, the better. The more times that prices approach that trend line and not violate it, the more valid it is. So here in a downtrend, we have 1, 2, 3 validations. Price moves down, you might have entered a short position here. Price moved back up to that trend line and bounced right off of it. That gives you another opportunity to enter that market or consider entering that market. You need more information. And you could have bought in this whole downtrend here. You have perfect opportunities with a valid trend line. Each time you see price bounce off the same line, the more likely it is that others are watching it too and playing the same game you are. This could help you get several good entries in a row. But remember, trend lines won't last forever. So you want to make sure you set proper stop losses and you get out quickly if the support and resistance trend lines eventually fail. Three, and the most important, is you want to buy into bullish trend lines and sell into bearish trend lines. The trend is your friend. The steadfast rule always applies to trading trend lines. For experienced traders, this basically means we should only look to buy at bullish support lines and sell at bearish resistance lines. For traders not into trading jargon, just follow the image below. When the markets are moving up, you want to buy. When the markets are moving down, you want to sell. Trading only the direction of the trend will let you exploit potential trend line bounces as efficiently as possible. And while they won't always give us winning trades, the trades are winners should give us more pips than when we've been attempting to place trades against the trend. Coming full circle, Trend lines are a very simple tool to use. You are connecting the dots on a chart, but hopefully the 3 tips will help you draw them correctly. Make sure that the lines you draw are connecting 2 or more highs or lows, but have not been broken by price between those points. Remember to look at a third bounce to validate that trend line. Also, make sure you're taking advantage of trading with the trend by looking for buys in bullish markets and sells in bearish markets. Now, whether you use trend lines or indicators, price action, price on the chart, is what ultimately determines how much money we make. Learning about price action, how trends move, is never a bad idea. But remember, trends and trend lines are 2 separate animals. Prices can constantly move up and down, even within a trend. While most traders know this, they have a hard time applying the knowledge in real time. Traders often wait too long before entering, buying at the top of a price wave, panicking at the pullbacks, and selling at the exact same time they should be considered buying. So if you firmly believe and you learn and you bang it into your head, and this is what I do, I want, it's like I'm begging to see that retracement. I'm begging to see the price ease down because I know I need to have this for my price to continue moving up. You know, it's like when I was in college, I was a fundraiser for the Democratic National Committee in the U.S. And the manager who stood behind me all day, and believe me, he stood behind me, would tell me, don't get discouraged when you get a no or a hang up, I'm too busy. He said, you're only going to close 1 out of 10. So if you think about getting through the 9 hang-ups to get to the 10th one, you're just happy. Same thing on trends. If you realize that a trend has to move up and then ease back down, has to move up and then ease back down, move down, you will feel comfortable when you see that easement. Otherwise, you end up selling and buying at the wrong times. So trend lines and trends are basic pieces of information. Once you've learned to read your chart and you can put a trend line on there, our next class is support and resistance, and then you look at volume, you actually have yourselves an entire trading system. But it also has completely built your blocks, your foundation, for then adding on other types of decision-making tools. So on that note, guys, I'm going to say goodnight to everybody. I hope you enjoyed tonight's class, and I hope you learned a little bit. And I will see you next week, and we have some new classes on the schedule. And I will wait to see you very soon. Thank you very much, and thank you for supporting ETX. And thank you for listening to my raspy voice.